is State Street Global Markets Senior Fixed Income Strategist Jon Herrmann. I want to bring Jon into that conversation. Herrmann, by the way, he's the Bloomberg best on GDP, and he proves it because you had a forecast of 1.8%.
So that was a good thing this morning. Betty, basically, I just skimmed through the report. And overall, I think Ben Bernanke's characterization yesterday was, spot on. We saw, big impact from weather on various components of GDP, whether it was on all the construction levels, at all three levels, residential, at the public government level, also at the business structure level. We also saw weather, I think, even though inventories were pretty decent, I think weather actually impeded some of the manufacturing sector's run rates, and it actually could have impeded the inventories. So we would look for inventories even in the second quarter to advance. I think overall you have to look at this report and say this was really a very decent report, and it should give you optimism about second quarter growth. We were forecasting 3.1% in the second quarter from this 1.8 level, but it's possible we could actually beat that 3.1 level.
So is it possible then, Jon, that this could be the weakest quarter we see for 2011?
Believe it or not, I think I would definitely be in the camp that would say yes. And the reason why is because part of the baseline view we have for this year is the inventory replenishment cycle has to really ramp up, and it should contribute dramatically to especially third quarter growth. And in addition, business CapEx spending should really be, it was decent this quarter, surprisingly, but it should actually accelerate and strengthen over the course of the year. So business CapEx can be good. And the job growth just continues to support consumption, even with these gasoline prices, at almost $3.90 a gallon.
Jon, you make the point about inventories. They did contribute quite a bit this time. They rise to $48 billion in the prior, or $43 billion in the prior quarter. It was only $16 billion. The question is that involuntary restocking? Are we going to come back in and start buying up this stuff?
Oh, no. I don't think you have to worry about that. When we look at the inventory to shipments ratio, I think we're going to be very satisfied and seeing that it's really remaining at a cycle low and a multi-decade low. So I don't think inventories are out of line at all with the shipments. And you can see from consumption, we have very good demand there. And business CapEx was solid as well. So this also points to, even inventory shipments ratio in the wholesale in that part of the supply chain should actually be pretty low. So I think inventories are not really out of line with shipments, and we're at a go signal here.
Does this mean that the Fed is going to stay accommodative throughout the rest of this year then?
Yes, for a couple of reasons. Number one, Ben Bernanke still needs greater clarity on the resumption of consumer spending, inventory stockpiling, business capital spending. We also need to see small business formation improve and strengthen. And as Mike just mentioned, we're a little bit concerned about the jobless claims upticking in the month of April. So the Labor Department initially said a couple of weeks ago that there might have been some difficulties seasonally adjusting that number in early part of April, but now we've seen it for a couple of weeks in a row. So,
what does that mean? So, Jon, does that mean that we're going to stay around this sort of 9% level in the jobless rate for a while?
I don't think so. I think we're actually going to still continue to grind lower in the unemployment rate. But what it may mean is that the pretty good clip of private payroll growth, which averaged 188,000 per month in the first quarter, we may slide back a little bit towards about 150 to 160, something in that range going forward. But we have to just monitor that very carefully.
Okay, and Jon, just also answer this one, because you were talking about inventory rebuilding among companies. How much of the GDP growth coming this year is going to be from inventory rebuilding, and how much is it going to be from consumption?
Consumption we're looking for consumption to average, close to 3% over the course of the whole year. Inventories, though, should be contributing somewhere on the order of about 1.5 to grow. It should be a very healthy contribution. And what it should do is offset the big drag that we're expecting from state and local government.
Okay. All right. With their budget cuts and layoffs. Jon Herrmann, thank you very much from State Street.